So over the last 2 days, JP Morgan has moved about 7 million ounces from the eligible category to registered. You can see here. Here is the activity report for February 28th. You can see here that they moved 3,436,925.71 ounces from the eligible category over here to the registered category up here. Registered means for sale against futures contracts. Eligible means just storage, not for sale. And that was doubled, more than doubled, by the moves from March 1st, or the activity. Really, it's a day lag, but whatever, you get the point. JP Morgan moved another 3.586,897.906 million ounces from eligible to registered. So they're moving 7 million ounces. The registered supply from the JP Morgan vault from 10.7 million to 17.7 million, just over 7 million ounces. The last time they did something like this was in July 2020 when they moved 40 million ounces from eligible to registered to supply the record deliveries that month in July 2020. But now you could say, well, JP Morgan has, let's see here, it says 129.9, basically 130 million more eligible ounces in storage that it could keep supplying the silver market with. But that's not really true, because if you look down at this table here that I screenshotted from the SLV ETF as of March 2nd, 2023, which is Thursday, you have here 103 million ounces that belongs to SLV and the JP Morgan New York vault, which is the same vault as this. So they have 129.9 million. 103 million of that is SLVs. So, JP Morgan can't really sell that. Well, who knows what they might try, whatever, but I'm not making that argument here. So really they have about 26 million, 25 million, something like that, ounces left. And we don't know how much of that is privately owned. So JP Morgan is running low on eligible silver to supply the futures market with. Now the question is, why are they moving so much ounces into the registered category specifically now? We don't know, but it could be that they are short a lot of contracts and need to cover them, and they're expecting a big delivery month ahead. Now, I wanted to look at a long-term picture of open interest versus the silver price. And now we have 4 distinctive periods here separated by 2 financial crises. The financial crises, plural of crisis, you can see here in 2008, 2009, that is when the silver price deflated along with everything else, from the high of about $21.50 in March 2008 to a low of whatever it was, I think $10 or whatever it was, I don't know, in the financial crisis depths of late 2008. The other financial crisis was here during the lockdowns of 2020, and that was when silver crashed from about, again, $21 or so to about 11 or so. Anyway, these are 2 dividing times. So you have here on the bottom open interest, the amount of contracts that are open in the silver market versus the silver price. So from 2000 to 2008, you had a rising open interest and a rising silver price. That suggests that the action is being driven by the paper markets, because the higher the open interest, the more contracts that are open. People are buying more paper contracts, right? The silver derivatives, the price goes higher. Okay, so that's the silver market, but mostly focused on paper. And then you have a financial crisis where or deflation, and people need to pay their debts. They need dollars, so they're selling everything they can to get dollars, and the silver price goes way down, and so does the open interest. The contracts go, all the inflationary, contracts collapsed here, and you can see here this really spike up in open interest that suggested that we were at the peak of a speculative period in silver here, and then it just deflated during the financial crisis into late 2008. Now we reset. It's the same sort of paper-driven bull market, except it's much more extreme. Here's the price going from about $10 to the high of 50 when silver quintupled from 2008 to 2011. We all remember that, assuming we were alive. And if you weren't, then you must be like 12 years old, which is really cool if you're a really young silver stacker. I'm glad you're here. And so open interest was still rising along with the price. And then we go into a bear market where we have basically higher open interest in silver, and there's more and more speculation in silver. You see the bars going up and up and up, trending higher here, and the price just keeps going lower and lower and lower and lower. You could call this the silver derivatives manipulating the price. You could call it just a bear market, whatever you want to call it. That's what happened. It wasn't good. And then what happened? You had another financial crisis. And now what's happening is unlike what has been happening here in this bull market or here in this mega bull market here after 2008 and 2011. But this is different. You have a trending higher price. And yes, it is trending higher from the 2020 financial crisis lockdown money printing madness. You have falling open interest. And despite the falling open interest trending down since 2020, you have a rising silver price. And yes, it doesn't feel like it now, but we're still trending higher from 2020. So despite falling open interest, you have a higher silver price, which means, first of all, the paper markets are not leading the price here. They're either following it or maybe contributing a little bit, but you have a situation here where despite lack of interest in the paper markets, you have a rising price. And that means when the speculative fervor starts, it's going to really explode. And the fact that silver can trend higher, even though open interest has trended down from about 200,000 contracts to about 124 over the past 3 years, it's pretty impressive if you just zoom out and consider that. And so what is driving the price higher? I think it's the physical demand.